Welcome. Moss Adams is pleased to present today's webcast, Government Entities, Economic Outlook, and Industry Update. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Michelle Walker, Director of Investment Strategy, and Sheila Herrera, Senior Manager with our Government Services Practice. With that, I'll turn it over to Michelle to get us started.
Yeah, good afternoon. Thanks, Pam. As she mentioned, my name is Michelle, and I'm the Director of Investment Strategy at Moss Adams. And today I'm really pleased to give an economic and market update where I'll be touching on stock and bond market trends, government stimulus, monetary policy, GDP and unemployment trends, inflation, the dollar, and interest rates. And finally, I will cover the Build America Better Infrastructure and Jobs Plan that is currently in the works in Washington, D.C. And then I'm going to turn it over to my colleague, Sheila, who's going to give an industry update. All right, so go ahead and get started. On this first slide, it shows the major pullbacks in the stock market over the last 25 years. You can see on the far right the market drop which occurred last March during the onset of the pandemic. It was quick and it was severe, with the S&P 500 dropping a whopping 35% in just 1 month from its all-time high in February to its low point on March 23rd. In terms of the stock market, a fall of greater than 20% from a recent high is considered a bear market. But then, almost as suddenly as it began, the bear market ended. The rebound from the late March lows was so quick and strong that it capped the shortest bear market in all of history, just 1 month, and marked the fastest round trip back to the all-time highs ever. We came back to the previous pandemic levels in just 181 days, which is unprecedented. So there were many reasons for this quick rebound in the markets, including a very big one, unprecedented monetary policy support from the Federal Reserve, massive fiscal packages from the U.S. government, and a macro setup in the economy which really just wasn't set up for a recession. And what I mean by that is that in each recession preceding this one, we had one or more of the following macro elements heading into the downturn, like something bad was happening. So something like a commodity price spike, which happened with oil in the 70s, or extreme valuations, for example, what happened in the tech bubble in 2000 or the housing market bubble in 2008, or sometimes it's a more cyclical downturn driven by like an overly tight Fed. But coming into 2020, we really didn't have any of these things in place. Commodity prices had been relatively low. The Federal Reserve had been really quite accommodative on rates, and valuations looked, kind of in line with normal valuations. So none of those normal things that precede a recession were in place. So this time, really, just instead of a recession driven by cyclical factors or asset bubbles, which are just definitely more typical, we had an event-driven recession. So this recession was brought on, as you know, by the exogenous shock of the pandemic, which basically closed down an otherwise healthy global economy. In fact, when you're comparing this most recent recovery to the global financial crisis back in 2008, it's kind of like comparing the tortoise and the hare. The aftermath of the financial crisis was slow and lengthy as we purged the excesses from the system. In contrast, this recent recovery has been sharp and will likely be more V-shaped. The difference this time in the potential strength and speed of the recovery can be attributed to a couple of factors. One is a supply versus demand-driven recession. So the financial crisis was a demand-driven recession in which housing and financial market excesses led the economy to overheat and then to collapse, destroying demand and therefore growth and employment in the years that followed. Looking at this chart, you can see that the stock market actually did not recover to the pre-crisis levels in 2013. So it took about 5 years after the financial crisis, where, as I just mentioned earlier, it was only 181 days for the stock market to recover from the sell-off from COVID. And again, that's related to the actual health of the economy going into the exogenous shock, if you will. So, this current pandemic, on the other hand, just, simply shocked an otherwise healthy economy. And during the lockdowns, supply was quickly reduced, but through things like, activity and capacity restrictions and not by really any macro factors. And so now that the supply has returned to the system and activity has returned to normal in the wake of vaccine distribution, we now have some pent-up demand that is able to be realized. So people have been sitting at home, not able to consume the way they would have normally done if the economy was open. Another important difference this time versus the financial crisis is consumption behavior, goods versus services. So after the great financial crisis, consumers weren't purchasing big ticket items like homes or cars, but they still were consuming services. This time around, consumers continued to buy goods. They just merely shifted their spending habits to online purchasing. Housing, contrary to before, is boomed and auto sales recovered really quickly. However, consumption of services dropped severely as people were forced to shelter in place and weren't able to go out and do the things that they would normally be doing. In fact, consumption of actual goods is currently 7% higher than it was pre-pandemic, so people are definitely purchasing goods, but services are still down by 5%. And because consumption of services in our economy is double that of goods, it does really dominate the employment picture, and this has been a challenge during the pandemic, causing widespread unemployment. However, as painful as this has been over the last year, this will likely be a significant tailwind, as we look forward and reopen the economy, because many of those service jobs are coming back very quickly. In fact, we're even seeing that some, hotels and retail chains and restaurants are saying they're having trouble even finding people to come back to work in some instances. So finally, and likely the most important factor driving this rapid recovery this time, again, was just really the swift and very large response from the Federal Reserve and the U.S. government. It was actually quite bigger than anything we've ever seen. So I'm going to talk a little bit more about that. On this slide, you can see the Federal Reserve has supplied about $3.5 trillion so far in monetary policy support to the credit markets through various lending facilities. During both the financial crisis and the pandemic, the Federal Reserve cut rates immediately to zero. However, credit continued to be really tight during the financial crisis. Alternatively, throughout the pandemic, lending and access to credit has remained really robust. And this, again, is primarily due to the sheer size and speed at which these facilities were rolled out. In fact, the monetary support provided during the pandemic is now larger than all of the support that was provided by the Federal Reserve from 2008 to 2012. So bigger than everything that was done post-financial crisis for 5 years. It's been bigger than that during this pandemic, and it's nearly doubled the Fed's balance sheet in one short year. This very significant support has been effective in maintaining the orderly flow of credit across all of fixed income markets so that businesses, states, municipalities, and of course the U.S. government could easily obtain credit with reasonable terms throughout the pandemic. These facilities were put in place, and they supported open market purchases in things like U.S. Treasuries, agency-backed mortgages, commercial paper, investment-grade corporate credit, municipal bonds, of course, and in some cases even allowed for the purchase of certain kinds of high-yield securities. So in addition to this, massive monetary support from the Federal Reserve, we also had big fiscal stimulus packages, which I'm sure you all know. So to the right here, you can see that there was 6 different packages that occurred throughout the pandemic, and that was provided to combat the pandemic and mitigate the economic burden on families and businesses. So with a price tag of $5.3 trillion thus far, which is about 25% of GDP or gross domestic product, these packages in size are considerably larger than the $831 billion, which was issued in the American Recovery and Reinvestment Act of 2009, which was just about 5.8% of GDP at that time. So you can see just the massive scale of what has been done both for monetary policy and fiscal policy to combat the pandemic versus what was even done during the financial crisis. On this slide, you can also see the breakdown of the support that was issued through, again, those 6 different bills, with the majority going towards support for small business, economic stimulus payments to individuals and families, expanded unemployment compensation, public health, tax incentives, direct aid to government, and educational support. And currently underway, as I mentioned before, are negotiations for the Biden administration's infrastructure package that could have a price tag as high as an extra $2 trillion. So I'm going to cover more on that in a bit. So going to the first polling question, which of the following do you think is not a goal of the Fed intervention in credit markets? To facilitate the orderly function of the credit markets, providing liquidity and fixed income products, including municipal bonds and corporate credit, to enable companies to seek out debt financing in the capital markets with reasonable terms, to make the stock market go higher, or to keep yields low to stimulate lending. So I'm going to go ahead and give you a few moments to respond. As was mentioned earlier, please click the button to answer where you choose and hit submit. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. Once you've completed all CPE requirements, you will be able to download a PDF of your CPE credit, your CPE certificate from the CPE progress window to the right side of the view.
And it looks like we have our poll results here, Michelle.
Oh, okay. I'm not seeing them pop up there, but I will go ahead and just answer. So why the Federal Reserve measures I described do add additional capital into the economy in the effort to support lending and the orderly function of the fixed income markets? It's not the Fed's explicit intention to boost the stock market, although that can be and sometimes is an outcome. So the answer would be C. Okay, moving on to the next slide. An additional outcome of all of this money printing is the growth in the money supply, or M2. So M2 is the term used to measure all of the money supply that includes cash, checking and savings, deposits, and money market accounts that are available throughout the economy. So M2, not surprisingly, with all this money printing, is up about 28% over the course of the pandemic, from 15.3 trillion to 19.6 trillion, and that is the fastest pace of growth ever on record. So out of the 3.5 trillion printed by the Federal Reserve for monetary policy and the more than 5.3 trillion distributed by the government for their fiscal response to the pandemic, a whole lot of it has ended up in savings accounts and money markets. So because families were staying home during the pandemic and not consuming like they normally would, there's been considerable savings on average across families and consumer balance sheets. Of course, this is not for everyone, but this is on average, and balance sheets look strong. This is very unusual coming out of a recession, and surprisingly, on average, again, household debt service ratios and household net worth are at the best levels in decades. During the pandemic, households have stockpiled nearly $5 trillion in excess savings, and economists actually predict that if they were to spend just 1/3 of that as confidence returns, it would boost GDP by 2% in 2021 and 2% in 2022. With the rollout of the vaccines combined with pent-up demand, most economists are expecting a very large print of GDP, or gross domestic product, into the back half of this year as people get out and about again. One last note on M2 and the money supply, which is interesting, is if these many trillions in excess savings are in fact used for consumption, then there's something called the money multiplier effect, which can give an even further boost to the economic recovery. And really what that means is just for each dollar that's spent, there will be a proportionally larger than $1 impact on GDP. And the reason that happens is because if consumers start to go out and fly, right, the airlines will then, have more flights and hire more, more employees. And those employees, as they, start making money again and get back to work, will take their families out to dinner and spend money, and the restaurants will hire more, servers, and the servers will get tips and consume more things. So it's kind of called the velocity of money, which means how many times can a dollar turn over in a recovery. And it can happen very quickly and be very powerful coming out of a downturn like this one. So again, that's the slide. Consumer balance sheets were strong, like I was mentioning, very unusual coming out of recession. So this next slide is looking at the economic growth and composition of GDP. So real GDP dropped by a staggering 31.4% in Q2 of 2020, as the global economy was basically forced to lock down due to the pandemic. However, GDP has bounced back quite more quickly than most expected, and by the end of last year, year over year, GDP was only down 2.4%, and they were expecting something much worse than that. So we actually managed through pretty well on the back half of 2020. So, and as I mentioned before, GDP figures are expected to be quite large as the economy reopens, and we could get very robust growth into 2021. One of the things that's interesting is you can see by the chart on the right-hand side that actual consumption makes up about 68% of U.S. GDP. So consumer confidence will be really important as an indicator to watch as we navigate to the other side of this pandemic. This next slide shows the dip in consumer confidence that occurred, during last year, early on. And though it did decline dramatically, confidence actually did not reach the low seen during the Great Financial Crisis, even at the height of the lockdowns. Confidence levels have been creeping higher, and the next print is expected to be actually close to or even above pre-pandemic levels. So on average, confidence has returned quite significantly. So we'll move on to another polling question. For some reason, this is not wanting to advance for me.
Oh, here, Michelle, do you want me to read the question?
Well, actually, can you just advance the slide?
Oh, yeah, sure. It's actually on here.
Oh, there we go. Sorry, for some reason it separated from me. Okay, so anyway, on to the next polling question. What do you think will be the shape of the economic recovery? V-shaped, so we are on our way and we'll be back to 2019 levels of growth and productivity by the end of 2021. J-shaped, we are on our way, but it will take several years to fully recover. L-shaped, we will be in a prolonged downturn for quite some time. And I'll go ahead and give you some more time to respond. Again, to participate, just please click the button next to the answer you choose and hit submit.
We'll just give it a few more seconds. Here it's looking like we've got almost all responses in. All right, so I'll go ahead and close the poll. And here are the results, Michelle.
Great. Oh, great. Okay, there we go. So 47.8% V-shapes. Right. So while there is really no right answer because we don't really know yet, from the things I have described, things are definitely looking up, and most economists do predict that we will have a very robust recovery, at least in financial conditions in the back half of the year. So it's looking more like V-shaped. Okay, so another indicator speaking to the surprisingly quick recovery is unemployment figures. So the non-farm payrolls fell by a whopping 22 million in April of last year, which was just an astounding drop, and that was at the height of the lockdowns. And the employment rate peaked at 14.8%. Since then, however, the numbers are much improved, and the March unemployment rate came in at 6%, which is above the long-term average of, which is actually below the long-term average of 6.3%. But still worse than we were pre-pandemic, but 6% still better than the long-term average, so quite a quick recovery. And, even that being said, there is some anecdotal evidence out there that not only is the employment market getting better, but in some places it's actually tight. We are hearing that there are certain pockets of the economy where business owners are having trouble hiring employees. So something else that analysts look at to look into the health of the economy and how we're recovering is looking at what's called high-frequency data. On this next slide, you can see the 6 most commonly used data points, and they are purchase mortgage applications, consumer debit and credit transactions, hotel occupancy, travel and navigation app usage, U.S. seated restaurant diners, and TSA traveler traffic. So improvement has been most profound in mortgage applications and debit and credit transactions. However, all the other data points, including TSA travel figures, are all showing recovery. To briefly just touch on the robust mortgage application figures and the housing market, as you guys are probably all aware, the housing market acted quite differently during this recession than in the last one. So after an initial drop off in interest at the start of the pandemic, Americans actually got very connected with work from home comforts and turned their attention to home buying, either relocating or upgrading or remodeling. All sorts of things around the home were very popular last year. And interestingly, at the end of 2020, home prices were about 15% higher than a year earlier, according to housing market data. So this next slide is showing the valuation of the stock market as measured by the S&P 500's forward earnings multiple. It's always interesting and confounding to people that the stock market is really a forward-looking indicator. So, we got a lot of questions last year in the mid part of the year when the economic data felt so bad and looked so bleak. The stock market was actually rallying in anticipation of a recovery and better news out in the future. So now that we are just starting to see this recovery and the better economic data, the stock market has already actually run up so far that its forward price to earnings multiple is around 22 times next year's earnings, which is quite high compared to the historical average of 16.6 times. And what this is telling us is that the stock market has priced in some really good news, quite a lot of it, and maybe then some. So if you're watching the stock market, there is reason to believe there could be a pause here as we await the economic data and the earnings to kind of catch up to the multiples that are already priced in. Or even possibly we could get a pullback if some of the economic indicators don't come as strongly as is anticipated. This next slide here is showing the yield on the U.S. tenured government Treasury note going back as far as the late 50s. What is most interesting here is that since the peak in yields during the oil crisis in 1981, yields on treasuries have moved really in only one direction, and that is lower. The 10-year bottomed out last year at 0.5%. That was the yield. So that was where the government was financing their debt and where, an investor could invest in the bond at 0.5%. So it was very, very low. So, the rates have been starting to tick higher. And the move higher in yields is reflecting this, better growth prospects like I've been talking about, and then also some inflationary pressures or some expectations that there could be inflation. However, the absolute levels of yields, as you can see from this chart, are still very, very low. So the bottom line here is that fixed income as an alternative for investors in balanced investment portfolios is unfortunately not very attractive. Nominal yields are very low, and real yields, which is the nominal yield minus expected inflation, are actually right around zero. So, if you're buying bonds for investments, you're just not getting very much return for your investment, which is unfortunate on the investment side. However, from the financing side, it is good for corporations and municipalities and everyone else who's trying to lend money or extend credit. So on to the third polling question. So going back to all of this money printing, what do you think could be some of the potential consequences or implications? A weaker dollar, higher expectations for inflation in the future, in the long run, slower growth due to the higher debt levels the U.S. government has taken on, or all of the above. And again, we'll give you a few minutes. Go ahead and just click the button next to the answer you choose and hit submit. And for those of you that would like a copy of today's slide deck, you can download them from the folder that says slide deck and handouts to the right side of the slide view. We will also be sending the slides out via email after the webcast.
We'll just give it a few more seconds. It's looking like we almost have all responses in.
All right.
All right, here I'll close the poll, and here are the results, Michelle.
All right. So 85% said all the above. Spot on. So looking at this next slide, so the money printing we have seen to combat the recession has had some expected financial impacts. The dollar has become weaker, and inflation expectations have risen. Often expectations for higher inflation can be seen through like the purchase of hard real assets, which are expected to be a hedge against future inflation. So you can see here that gold did rise significantly in 2020, and other real assets like inflation-linked bonds, and yes, even Bitcoin have rallied as investors look for assets that may be a hedge against future inflation and this decline in the value of the dollar. Of course, the higher debt burden that has been taken on by the U.S. government will ultimately have to be repaid, so will likely reduce growth out in the future at some point. So the answer, of course, is all of the above. So this next slide is actually a chart of inflation, and it's as measured by the CPI, or the Consumer Price Index. You can see that recent prints are ticking up just slightly, but it seems pretty tame, actually, if you look at compared to the late 70s and early 80s. Within those numbers, we are seeing pockets of upward pressure in prices, mostly related to supply chain disruptions in areas such as food. You probably have all noticed food is going up in price, machinery and equipment parts, construction inputs like copper and lumber, However, thus far, it hasn't moved really the overall CPI index significantly higher, and that's what the Federal Reserve watches. And they do say that they expect such inflationary pressures that we're seeing here and there to be transitory. So it's kind of interesting to remember that during the financial crisis back in 2008, gold also rallied in anticipation of inflation, but we never really saw much inflation. And this was due mostly to technology innovations that improved productivity and kept prices low. So that's what happened after the last financial crisis or the last crisis. So it remains to be seen, though, how inflation will play out this time. Again, the Fed thinks that the pockets of inflation we're seeing are transitory. So finally, for the economic update part of our presentation, I thought I would wrap with the next leg of fiscal stimulus that is in the pipeline. Currently, the Biden administration has proposed the American Jobs Plan that is intended to reboot the economy and create jobs. Obviously, opinions will vary on what this plan should look like and how much it should cost. I won't read all of this, but this is a press release that was put out by the White House on March 31st. And I'll give you a moment. You can read it yourselves, and then I will tell you what we know about what's in the proposed package so far. So the initial starting point for the bill is around $2 trillion. I know that the Republicans are putting out a package which is about half that size, right around a little less than half that size. So there will be some negotiation going on around the actual size of this package. As it is in current form, it is focused on upgrading and repairing America's physical infrastructure, investing in manufacturing, research and development, and expanding key long-term healthcare services and child care. The focus in the plan specifically falls to transportation, buildings and utilities, jobs, and innovation. For transportation, the focus is on modernizing highways, repairing bridges, and building a network of electric vehicle chargers in an effort to revitalize the U.S.'s aging infrastructure and reduce reliance on fossil fuels that drive climate change. For buildings and utilities, investments would be in affordable housing, as well as improvements in energy efficiency. Also in the bill is support for bridging the urban and rural digital divide by building out broadband access and modernizing the electric grid for greater reliability and wider deployment of low-carbon electricity. And finally, jobs and innovation, which includes investing in the manufacturing sector with the goal of helping America to compete with those abroad in the race to build industries of the future like semiconductors and advanced batteries, as well as spending on worker training, retraining, and R&D. So finally, of course, it doesn't all come without some sort of prize. So the plan is going to likely include a number of tax increases, which are not fully known yet, but will probably include, for sure, hikes on corporations, among others. And so that wraps the prepared economic update portion of the presentation. And now I want to introduce my colleague, Sheila Herrera, who's going to give an industry update, and then we will open it up for questions.
Thanks, Michelle. That was fantastic. A lot of insight there. Some of you, it looks like, have a few questions that we'll get to here at the end of the presentation. We have some time set aside for that. And so I want to speak specifically to the impact from the American Rescue Plans on state and local governments. We're seeing a lot of things popping up as far as what's being communicated. And so really helping here to identify some high-level things and then maybe some items, that you all can start to prepare on what to do going forward. And so from the state fiscal recovery funds, states are expected to receive about $219 billion. Of that total, $25.5 billion is expected to be split evenly. There's another $168 billion that will be distributed based on each state's share of the total unemployed workers over the covered period from October through December of 2020. And so, as Michelle noted, there was a significant change in the unemployment over the last year. And so that will be the period that will be used as the basis for that money. States will be required to certify to the U.S. Treasury that it will use those payments in compliance with the use of fund restrictions before any distributions are made. And so once that certification is received from the states, payments are expected to be made within 60 days. 50% of those funds are allowed to be withheld by the U.S. Treasury for 12 months, and then a second certification will be required before funds are paid to the states for the other monies. So just some things there from the state perspective. From the local fiscal recovery fund, there's been an allocation of $130 billion. Counties are expected to receive the $65.1 billion in population-adjusted payments based on each county's share of the population, and then adjustments for CDBG recipients. So there are allocations if certain counties do receive CDBG funds already. Those CDBG monies are already in your CFA, and so those adjustments will be made. Metro cities will receive about $45 billion in payments. And then non-entitlement units of local governments will receive the $19.5 billion in payments distributed by individual states. What is a non-entitlement unit? The definition for that is, cities, townships, villages, small municipalities that generally have fewer than 50,000 inhabitants. I know I've seen a lot of research specifically, or even communication from the National Association of Counties for some of these smaller non-entitlement districts. And then local governments will not be required to certify funds, but they will receive the funds in tranches. They'll also be required to report the money and how it's being used, and we'll get to that in a minute. The U.S. Treasury is required to start making payments to local governments within 60 days. Within the 60 days, and second payment no earlier than 12 months after the first payment. And so moving on here, so we have some allowable uses of funds for state and local governments. And so they can cover costs incurred through December 31st of 2024. They are funds that are supposed to be used to respond to public health emergency caused by COVID or its negative impact from either economic effects or losses of revenue. And so most states, local governments are already seeing huge significant impacts on their statements related to losses in revenue from various places, whether that's tax-related, decreases in activity in states such as tourism. They've seen significant budget cuts for things like that. And so states are having to go back and relook at their budgets for some of those lost revenues. The funds are supposed to be used to aid households, small businesses, and non-for-profits. Some households, are struggling to pay for basic utilities, pay for rent. Small businesses have had to shut down for periods of time and continue to feel the impact, depending on which states have local, orders in place. Capacity limits, for example, continue to be in place and are affecting a lot of these small businesses. Our non-for-profits are not operating how they have been in the past, and so they've been able to, go to a tangent work environment. They have been able to manage, but they still aren't really at how they were operating before. And then aid specifically related to tourism, travel, hospitality. Michelle mentioned that has started to see an increase. We are starting to see more of this happening as people either get vaccinated or are more comfortable doing these sorts of activities. And so there is funding that will be available for use to help some of these businesses that are suffering from this, or that maybe because of local orders have not been able to open up from a full capacity perspective. And then the next thing is to provide premium pay to eligible workers who perform essential work. Premium pay of up to $13 per hour per eligible employee, in addition to wages up to $25,000 is the cap, or grants to pay premium pay. And so the bill itself classifies eligible workers as those workers needed to maintain continuity of operations of essential critical infrastructure sectors and additional sectors of each chief executive officer of a metro city, a non-entitlement unit of a local government. A county may designate certain things as critical to protect, the health and well-being of residents of their metro city or non-entitlement or local government or county. And so that definition is a little bit broad, but it can be specifically designated by those local governments. And then to provide grants to employers that have eligible workers who perform essential work. Some employers have people, that are required to go into work each day. They cannot work remotely. They don't have that option. And so that's something that some of these funds can be used for. And then government services to the extent of reduction of revenue of each state due to the COVID public health emergency relative to revenues collected in the most recent full fiscal year prior to the emergency. So just helping with operations based off that reduction of revenue. And then one of the things that was added was to make a necessary investment in water, sewer, or broadband infrastructure. I think all of us are feeling some sort of pressure from the broadband space, given, we're maybe working from home. All of our family members are at home right now, and, our kids are at home. They're all using our internet, and so sometimes it makes life a little harder. There are areas that don't have the infrastructure that are in rural counties, states that need that to be inputted so that people can operate appropriately. And so some of the things the states cannot use the funds for is to directly or indirectly offset a reduction of tax revenue resulting from a change in law, regulation, administrative interpretation. They cannot delay the imposition of any tax or tax increase. So if there's already something in place that a state was going to do, just because they're receiving this money, they cannot make that delay. And then the funds cannot be used to fund or deposit any pension funds. So here is our fourth polling question. And so what are your challenges, not only regarding the American Rescue Plan money, but also the CARES money that you all have received, have been starting to spend? Is it, just understanding all of the rules and regulations related to this money and what you have to do from your end? The lack of resources needed to plan and implement certain spending. Sometimes, we all have various levels of responsibilities, and with resources low, it does present a challenge for many of our state and local governments to be able to plan and make sure that those resources are being spent accordingly. Tracking and documenting to meet certain compliance requirements. Along with all these rules and regulations, there are certain things that certain departments are asking for, such as reporting or making sure that the funds are being used appropriately. And so those are the things, are you sure you're documenting all those things? Or maybe it's all of the above. Maybe you all are struggling with, some of these things and really looking for some guidance on that. give it a minute here. Looks like we're about 80% so far answered.
I think we can close the poll. Here, I'll go ahead and close it, Sheila. And here are the results.
So all of the above, yeah, as we're talking to state and local governments, we are seeing a huge amount of information just being flown in different directions, it feels like. And so some clarification is often needed about all of the money that is, being spent. Are those the appropriate uses of funding from an allowability perspective? Are we really meeting the compliance requirements? Are we making sure that we're reporting to the government appropriately? How are you finding those ways to spend that money? And, have you made sure that it's in line with what your community really needs? So other kind of important items here, the covered period for when expenses can be used for this money is starting March 3rd. So again, this did go for a couple of years, so you do have a little bit of time to spend this money. There was also another $10 billion for states to carry out critical capital projects to enable work, education, health monitoring. Each state will receive about $100 million. And then there's no timing on specifically when those funds have to be spent. Capital projects tend to go a little bit longer to make sure that you have the right projects in place and you're using that money appropriately. And then local assistance, payments to eligible revenue sharing counties for 2022 and 2023. The Secretary shall reserve $750 million of the total appropriation to allocate based on economic conditions. And so what do we learn kind of from the CARES Act funding provided? This is the American Rescue Plan money is new money, but we did learn a few things from what has already happened over the last year. So it seems like there have been a lot of constant changes, questions. There was a lot of FAQs that came out about that money. We're still seeing some clarification on certain types of funding that was provided under the CARES Act, and we expect that to continue along with the same message on the American Rescue Plan money, that there will be additional communication that will continue to make some clarifications on this money, specifically as states are spending or requesting the funds and how they're going to be used. The strategize and plan early. What are you receiving the money for? Do you have a plan for how to spend this? Some of the states and local governments have already started making those discussions happen internally on how they're going to be spending that money, looking at where the biggest risks or needs in their community are. And then identifying, roles as you're doing your planning, who's going to be responsible for what, whether that's kind of the start of the project, how that money gets spent, how it gets tracked. We saw a lot of things in the CARES funding where our clients did a great job identifying, how to spend the funds, but then kind of failed to identify who was responsible for making sure all the reporting back to the federal government was being done. And so we noted that, as we're going through our audit process, and we want to make sure that you're planning for those things ahead of time and really thinking through, beginning to end, what this looks like. And then making sure that, you have the appropriate budgets in place. From a governmental entity perspective, you all are subject to specific budgetary requirements. And so as you determine when those funds need to be spent, whether that's going to be in the current fiscal year or a future fiscal year, you'll need to make sure that you have your budget adjustments in place and prior to spending the funds, and that those specific uses are identified, of course, in your budgets. And so knowing that period of availability becomes important since you do have a specific amount of time to spend the funds. You want to make sure that it's identified in your budget and that everyone understands the expectation of what those funds are to be used for. And then thinking about how your current structure is, you may have some internal controls or policies and procedures that need to be updated within your organization internally. And so maybe you have currently a small amount of federal dollars that you spend, or they have been specific to one program that you may operate. And so when you start looking at other types of federal dollars here, you may have internal controls or policies and procedures that may need to be updated internally. Things like allowable costs, maybe reporting, making sure that you have proper approvals in place, your segregation of duties is appropriate for these types of monies, whether there could be subrecipient money that flows through from the states to various places. That might be something to think about at some point. From a compliance perspective, how are you, tracking all of this money? Can your ERP system be modified appropriately? And timely is the next kind of thing, because maybe that's coming sooner than later, and so you need to think about, how is there a specific fund that will need to be tracking this money? Can we identify these expenditures in the system, as we need to report them back to the federal government? And then, at some point down the road, what compliance requirements, thinking ahead a little bit, there's been a little bit of guidance about whether or not, there has not been guidance about whether these funds will be subject to single audit yet, but thinking a little bit ahead about, we know that some of the CARES money specifically was subject to single audit requirements, and so some of those monies specifically had allowable costs, for example, that was applicable. They had reporting that was applicable, and so start thinking through. We know we might have these things that we need to be mindful of and accountable for. And then ask for help. A lot of times, like I said, there's a lot of information going in all directions. Maybe you're not sure. And then as you end your fiscal year here, what will need to get reported on the CFA, if anything. And so that'll be something, hopefully in the next couple of months, we should know more on that. If you even start spending the money in this fiscal year. If not, that'll kind of be something for the next fiscal year that you have. And so you may have, if it is or does end up being subject to single audit, you may now have additional programs that you would need to have audited. You might have a single audit and you've never had that before. So you'll need some additional time for, the audit process itself, for your staff, to make sure that we get through that audit process. Typically when we add, additional procedures or a full other type of audit here, that was probably not part of the original scope of the audit. There's additional money that, comes along with that. And then just making sure that the documentation on your end is really in place. And so that goes back to those kind of policies and procedures, your controls. You might need to put some memos together on your end to really have how all that money was documented, what the process has been, just to make sure that you're prepared fully for the audit process. If there are a lot of individuals involved in how this money gets spent, you want to make sure that, we cover that from all angles. And so finally, we'll jump into some Q&A here.
Yeah,
so Pam, do you want to go through a few of the questions?
Sure. We did receive a couple of questions, and then I think we had some questions that were submitted earlier, as Michelle was presenting. So, Michelle, can you address this question? Do you believe the U.S. reported inflation numbers reflect true inflation? In other words, is the inflation rate they report actually higher?
Yeah, it's a good question. There are actually many criticisms about the way the inflation figures are calculated. Actually, one complaint that comes up a lot is that the inflation measures that they use don't account for asset inflation. So home price appreciation isn't accounted for in there, which, as everybody knows, house price appreciation is pretty significant and does feel very impactful to us as we try and live our lives. What they base rent on is something they call owner-occupied rent. And often it's argued that the number that they use is actually too low, and it doesn't account for differences among, states and regions and things like that. So there's a couple different other things in the inflation measures that are, criticized for not being perfect. But I would say broadly, one of the main reasons that you see inflation being, have been declining basically in the last 10 years is really just all of this technology transformation and the productivity that it's created, and also just the ability to see through to prices. So one example I put out there is even the pandemic actually even boosted this even more. I mean, think about how much everyone used the internet to shop for things that potentially they didn't shop around for before. Everything they purchased, they went online and looked to see, what was the most competitive price. And that does keep prices fairly low for goods and things of that sort. But again, lots of criticism about things like housing price inflation and things like that. So it's not perfect.
Thanks, Michelle. And then here's another one for you. What do you think the infrastructure package will mean for municipal bonds?
Yeah, so one interesting note from the infrastructure package is that it could be actually quite constructive for municipal bonds. So municipal bond issuance has been really strongly supported by the stimulus from the Federal Reserve over the past year, and that will likely continue. The Biden plan that I talked about could actually be a boon for higher supply and investment in that space. So as the projects and plans include things like transportation, clean drinking water initiatives, affordable housing, and whatnot, those may overlap with municipalities. And there could be programs that actually subsidize or incentivize municipalities to issue loans under these programs. So, another thing to note is, on the demand side for municipal bonds, corporations, and I don't know if everyone knows this, but corporations own about 20% of the municipal bonds that are out there in their investment portfolios. And so if corporate tax rates do go higher, which it looks like they will, that could drive increased demand for owning these tax advantage type municipal securities in their portfolios, which could be a kind of a demand driver for municipal debt in addition.
Thanks, Michelle. And then we still have a couple of minutes here. And so here's a question for Sheila. Will the state and local recovery fund monies established under Arpa be subject to single audit requirements?
Thanks, Pam. As I mentioned, that's still not clear. The U.S. Treasury did put out about a week and a half ago now a little bit of guidance about making sure, that you have a DUNS number, and then you have an also active registration with the SAM.gov, which is that system for award management. And so making sure that you have both of those things, they're expected to provide some additional guidance in the next couple weeks, and to make sure that you all are kind of looking at that Treasury website for program updates and further updates. So there should be some clarification coming in the next couple weeks.
Sounds good, and we've got maybe a minute left here. So one more question. Where it says states cannot use funds to directly or indirectly offset a reduction of tax revenue, what does this mean?
That's a good question. I think, right now, some of the states are asking for clarification from the U.S. Treasury specifically. There is a memo out from the Attorney Generals of several states trying to get some clarification on what this means. The Treasury has decided to address the question specifically to whether income tax changes that simply conform a state or territory tax law with recent changes in federal income tax law are subject to the offset. And so regardless of the particular method of conformity and the effect on net tax revenue, the Treasury views such changes as permissible under the offset provision. And so we expect the Treasury to also address the other questions specifically related to the tax revenue that the Attorney Generals have brought up in the next couple of weeks as well.
Well, great. Thank you, Michelle and Sheila, for a great presentation today. Unfortunately, we are out of time, but if you submitted a question that we did not get to, we will do our best to follow up with you after the webcast today. So just as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy of your CPE certificate will be emailed within 3 weeks should you have any difficulty downloading it now. Also wanted to mention here, we've got some additional resources here. We've included links in the slide deck. And then we'll kind of continue to keep you posted. We have several webcasts that we're planning here throughout the year. So just be on the lookout for additional invitations to join us for our upcoming webcast. Again, and then here's our contact information for today's presenters if you have additional questions and would like to reach out to Michelle or Sheila. And finally, here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.